There's a certain dark elegance to how the United States manages its finances. It's like a financial acrobat who insists he's flying, while in reality, he's plunging headfirst into the ground. For decades, America has assured the world that it is the paragon of responsible economic stewardship, the shining city on a hill whose currency is strong, whose institutions are unshakable, and whose debt, no matter how massive, is always manageable. But there comes a time when even the most impressive illusion collapses. And today, the United States stands precariously at that edge, buried under a mountain of debt it can no longer climb out of, nor even pretend to control. Welcome to the story of a nation drowning, and somehow convincing itself the water is fine. To understand how the U.S. reached this point, we have to look at its debt structure, a system so dysfunctional it would be comical if it weren't. Steering the world's largest economy toward disaster. At the core is the federal budget deficit, an annual ritual where the government spends far more than it earns, then celebrates this achievement as if it were a national sport. Every year, Washington pretends to be shocked that tax revenues fall short of the nation's astronomical spending habits. Then comes the predictable solution: borrow more. Defense spending surges, entitlement programs expand, emergency bills multiply, and politicians assure citizens that more debt is simply the cost of maintaining global leadership. Apparently, empires don't come cheap, especially when managed like a teenager with their first credit card. But the real danger isn't just the total debt. It's the exploding interest payments. The U.S. is now trapped in a vicious loop. It must borrow more money just to pay the interest on the money it already borrowed. As interest rates rise, an inevitable response to the inflation the government itself caused, costs of servicing the debt approaches levels once reserved for entire national budgets. In other words, America is now financing yesterday's spending with tomorrow's taxes, all while pretending the bill will never come due. There will always be optimists who say, the U.S. has been in debt before, and nothing happened. Such optimism is charming and dangerously delusional. The difference today is structural, not cyclical. First, the scale of the debt is unprecedented. The United States has crossed thresholds that economists once believed were mathematically impossible for a stable nation to sustain. The debt is growing faster than the GDP, a textbook signal of long-term insolvency. Second, the political will has completely collapsed. In previous decades, there were at least theoretical discussions about reducing deficits. Today, the political system resembles two rival camps, arguing not about whether to spend less, but about how much more they can spend before anyone notices the smoke coming from the Treasury servers. Third, global demand for U.S. debt is weakening. Foreign buyers, once loyal patrons of American have begun diversifying, a polite way of saying they are quietly backing away from the coming train wreck. And fourth, demographics are turning against America. An aging population means more entitlements and fewer workers. The translation: higher costs, lower revenues, and a financial time bomb ticking beneath every projection. Add all this together and you get a simple conclusion. The U.S. debt is no longer a problem to be managed. It is a crisis waiting to erupt. The U.S. dollar has long been the world's reserve currency, a privilege that allows America to borrow cheaply, run deficits indefinitely, and act as the world's financial center. But even this privilege is beginning to crack. The symptoms are subtle to the untrained eye, but glaringly obvious to anyone who studies markets. Currencies don't collapse overnight. They erode quietly, like a coastline eaten away by an unseen tide. And the tide is rising. Inflation, the silent thief that governments use to erase their mistakes, has exposed the dollar's fragility. Trillions of printed dollars flooded into the global system, eroding purchasing power and shaking confidence. The government insists inflation is under control, but anyone who buys groceries or pays rent knows otherwise. Then there is the steady decline in foreign dollar reserves, a trend conveniently ignored in official press releases. Countries once dependent on the dollar are now reducing exposure, seeking alternatives such as gold, regional currencies, and even crypto. Furthermore, the rise of global blocs, economic alliances, and competing payment systems is gradually chipping away at the dollar's monopoly. None of these on their own can dethrone the dollar tomorrow, but together, they signal one thing. The world is preparing for a future where the U.S. is not the center of gravity. The dollar is still king, Yes, but it looks increasingly like a king whose advisors whisper behind his back and whose enemies gather just outside the palace gates. To be fair, the United States has faced serious debt problems in the past. After World War II, the national debt soared to levels that alarmed policymakers. But America then had something it no longer possesses today: a young population, strong domestic manufacturing, undisputed global dominance, and a political system willing to take painful, corrective measures. Throughout the 20th century, the U.S. often used the same strategies to manage debt: inflate it away, grow the economy faster than the liabilities, or leverage its geopolitical power to maintain global demand for dollars. In 1971, when the U.S. could no longer afford to maintain the gold standard, President Nixon simply ended it. Problem solved, or rather, delayed. The U.S. exported its inflation to the rest of the world and forced global markets to adapt. In the 1980s and 90s, the combination of high interest rates, technological expansion, and globalization helped restore financial balance, at least temporarily. But every era has its limits. Today's debt crisis is not a rerun of the past. It is far more severe because the world around America has fundamentally changed. The U.S. can no longer rely on cheap labor abroad, endless foreign capital inflows, or a population willing to shoulder ever-increasing tax burdens. The old tools no longer work. The old tricks no longer fool anyone. This sets the stage for what is no longer a distant risk, but an unfolding catastrophe. The United States is not merely mismanaging its finances, it is systematically undermining the very system that allowed it to dominate global markets for a century. The debt is unpayable. The dollar is weakening. The political system is paralyzed. Foreign confidence is slipping, and the tools traditionally used to stabilize the system are now accelerating its collapse. What comes next is not a simple recession or market correction. It is a structural unraveling, the slow but inevitable emergence of a new financial order in which the United States can no longer rely on debt as its lifeblood. And as we continue, the question becomes increasingly urgent. What will America do when the debt machine finally grinds to a halt? Because if history teaches us anything, it is this: when great empires drown in debt, they do not go quietly. They reshape the world around them. Have you ever wondered how governments handle massive national debt? You might picture dramatic debates or emergency laws. But what if I told you the most significant changes to our financial world happen in silence? They aren't televised. They aren't debated in public. They are quiet, technical adjustments that reshape our economy from the shadows. The uncomfortable truth is this: governments rarely solve their debt problems. Instead, they redefine them. They use tools that seem complex and technical, but are really just clever ways to shift wealth and risk without anyone noticing. Let's start with the big one: redefining debt without ever saying its name. A government can't just announce, "Hey everyone, we're making your savings less valuable to pay off our bills." That would cause panic. So, they use stealth tactics. First, there's inflation. We're told it's caused by supply chain issues or global conflicts. But historically, inflation has been a government's best friend when it's buried in debt. Think about it. If a country owes $1 trillion and inflation hits 20%, the real value of that debt shrinks by 20%. Savers and anyone holding cash lose purchasing power. The biggest debtor of all, the government, wins. It's a stealth default. No one declares it, but the effect is the same: a quiet transfer of wealth from your pocket to the state. Next up is currency devaluation. It's another move wrapped in confusing jargon like enhancing competitiveness or responding to global conditions. But when a country's currency loses value, its debt becomes easier to manage. Your money buys less, but the government's IOUs become cheaper to pay back. Again, you lose. They win. Finally, there are market interventions, often disguised as stabilization or ensuring liquidity. But let's be clear. When a government supports the market, it's really shaping it to fit its own political needs. Intervention isn't a glitch in the system, it is the system, and no institution embodies this more than the Federal Reserve. To really understand how the rules of money are read, you need to see the Fed not just as a central bank, but as the world's largest manager of financial risk. Its power goes way beyond setting interest rates. The Fed decides how expensive money is, how fast debt grows, and which banks get bailed out during a crisis. It decides where market bubbles form and who ultimately pays the price when they pop. How does it do this? One key method is pumping huge amounts of cash into the system. When markets get shaky, the Fed steps in. But who gets this money first? The big banks and financial institutions. Who gets it last? Ordinary people like us. By the time that new money trickles down, asset prices, like stocks and real estate, have already skyrocketed. Wealth shifts upward. The public ends up buying at the top, while the insiders who got the cash first sell into the rally. This isn't an accident. It's how the system is designed. Then there's the control over interest rates. Rates determine the cost of your mortgage, a business loan, and most importantly, how fast government debt piles up. When the Fed keeps rates artificially low, it fuels a borrowing binge. The government benefits the most. The corporations are right behind, borrowing cheap money to buy back their own stock and inflate their value. The Fed doesn't just react to the economy, it actively shapes it. And the timing of these boom and bust cycles often seems to align perfectly with political needs. But the Fed's most overlooked function is transferring risk to the public. In every major crisis from the 80s to 2008 to the pandemic shock and the recent regional bank failures, the pattern is the same. During the good times, the private sector keeps the profits. When things go bad, the risk is magically moved onto the public's shoulders. The Fed buys up toxic assets and guarantees losses. The message is crystal clear. Profits are private, but losses are socialized. You, the taxpayer, become the ultimate backstop. Beneath these broad strategies are even more obscure tools that have massive influence. These aren't conspiracy theories. They are documented programs. There's Operation Twist, a financial sleight of hand, where the Fed manipulates long-term borrowing costs without officially changing interest rates. The public sees stability, but behind the scenes, the market is being engineered. Then there's quantitative easing, or QE, probably the most misunderstood policy of our time. When the Fed prints trillions of dollars to buy assets, it's not just stimulating the economy. It is deliberately inflating asset prices, forcing investors into riskier bets, and making it incredibly cheap for the government to borrow more and more. QE creates winners and losers by design. It just does so in a way that's so technical. Most people don't question it. And let's not forget the repo market. This is where financial institutions borrow trillions of dollars from each other overnight. In 2019, this market nearly froze, which would have triggered a global financial heart attack. The Fed quietly injected hundreds of billions to prevent a collapse. Most of the world never even knew how close we came. There was no public debate, no vote in Congress. It was a decision made by a handful of technocrats behind closed doors. All of this points to a fundamental shift in how our economy is governed. We've moved away from clear rules and transparent policies. Instead, we have what you could call governance by signal. Central banks now manage our expectations more than our money. They use subtle hints in speeches, strategic wording in press releases, and carefully timed leaks to guide markets. Markets no longer react to what the Fed does. They react to what they think the Fed might do. It's no longer about monetary policy. It's about narrative management. The United States has quietly transitioned to a new model. The old system of interest rate targets and debt ceilings has been replaced by a system of flexibility, improvisation, and strategic confusion. It's a world where markets run on hints, risk is absorbed by the public before they even realize it, and crises are just opportunities to inject more liquidity. In this new world, debt almost loses its meaning, because the central bank can always print more money to cover it. This isn't a secret plot. It's the logical endpoint for a global economy built on ever-expanding credit. When the debt becomes too big to ever be paid back, governments don't admit defeat. They they change the definitions. They manipulate the signals, and they rewrite the rules of the game. Quietly, technically, and inevitably. For thousands of years, empires have crumbled, currencies have vanished, and entire political systems have been wiped from history. Yet, one asset has survived every revolution, every collapse, every single monetary experiment. Gold. Its survival isn't a coincidence. It's not just some cultural habit we pass down through the ages. Gold endures because it serves a purpose that modern financial systems keep forgetting until it's too late. It is the final anchor of trust when debt spirals out of control. Think about it. As governments redefine what debt even means, as central banks manipulate economic signals, and as our global economy becomes more leveraged than ever before, gold is quietly making a comeback. It's not a dusty relic from the past, but an old weapon being polished for a future crisis. In this age of digital money, high-frequency trading, and complex algorithms, it sounds almost primitive to believe that a metal dug from the ground holds more credibility than a nation's currency. But gold has something that no government-issued money can ever replicate. It carries no liability. A dollar is a promise. A bond is a promise wrapped in fancy legal terms. A central bank reserve is just a promise backed by another promise. But gold is not a promise. It's a fact. This difference becomes absolutely critical when national debt grows so large that paying it back becomes mathematically impossible without devaluing the currency. And when the public starts to sense this unraveling first slowly, then all at once the demand for something outside the system explodes. History shows a clear pattern. When empires overstretch, gold demand rises. When currencies weaken, gold stabilizes portfolios. When governments lose credibility, gold becomes a political tool. And when debt hits unsustainable levels, gold becomes the reset button. The world today is entering precisely that phase. To really get why gold is returning, we need to look back at the moments when it defined the entire global financial structure and the moments when abandoning it unleashed decades of instability. In the late 19th and early 20th centuries, the world operated under the classical gold standard. Every major currency could be exchanged for a fixed amount of gold. This system forced governments to live within their means. They couldn't just print money endlessly, because every dollar, franc, or pound had to be backed by a tangible reserve of gold. For everyday people and investors, this created incredible stability. But for governments, it was a cage. The moment wars broke out and spending exploded, that cage became unbearable. To finance conflicts, governments suspended the ability to convert currency to gold, and once they tasted the freedom of printing money without any restraint, they never fully returned to that old discipline. After World War II, global leaders tried to find a compromise. They wanted a system stable enough to prevent chaos, but flexible enough to allow for some controlled money creation. The result was the Bretton Woods Agreement. In this system, the US dollar was pegged to gold, and all other currencies were pegged to the US dollar. This effectively made America the central banker of the world, but Bretton Woods had a fatal flaw. It all depended on the belief that the US would never print more dollars than it could redeem in gold. By the late 1960s, that promise was broken. US spending on wars and social programs soared. Foreign nations started getting nervous and began demanding their gold back. America was facing a mathematical impossibility. There were far too many dollars floating around the world, and not nearly enough gold in its vaults to back them up. Then came the Nixon shock. On August 15, 1971, President Richard Nixon went on television and announced that the U.S. would temporarily suspend the dollar's convertibility to gold. That temporary suspension became permanent, and it marked the birth of our modern financial era. Without gold as an anchor, governments could expand debt freely. Central banks could manipulate the money supply at will. Inflation became a standard policy tool, and the financial sector ballooned to a size never before seen. Debt was no longer a problem to be solved. It became the very engine of economic growth. The global economy we live in today built on leverage, liquidity, and complex financial engineering was born the moment gold was removed from the equation. But the longer a system floats without an anchor, the more unstable it becomes. So, where does that leave us today? Is the United States quietly preparing for a future where gold matters again? Officially, the U.S. claims to have one of the world's largest gold reserves. But unofficially, some analysts believe the real strategy is far more subtle. The U.S. may not be openly stacking up physical gold bars, but it could be accumulating indirect control over the global gold market. There are some important clues. First, control over the major bullion markets. Through institutions like COMEX in New York and the LBMA in London, US-aligned entities have immense influence over gold's price, often more so than physical supply and demand. Second, the expansion of gold-backed financial products, ETFs, derivatives, and other synthetic gold instruments give the US leverage over gold markets without needing to own more physical metal. Then there are strategic partnerships with major gold-producing nations. Controlling mining companies and trade networks can be just as important as what's in your vault. Finally, by shaping gold's price through these paper markets, the US can defend the dollar's dominance while keeping gold's price movements predictable. This strategy lets America influence gold without ever admitting that it still matters, which would contradict the entire post-1971 narrative. In geopolitics, denying your dependency is often a sign of a much deeper dependency. This brings us to a key point. Gold prices are often managed through futures and other paper markets. Gold is one of the few assets that directly challenges the authority of central banks. Unlike a bond or a currency, gold cannot be printed, controlled, or devalued at will. So, large institutions have a powerful incentive to manage its price, not to crush it forever, but to shape its rise in a gradual, predictable way. This is mostly done through what's called paper gold. Futures contracts allow massive amounts of synthetic gold to be traded, with very little physical metal backing them. Leverage in these markets can be 50-1 or even higher, meaning a small number of institutions can move prices with huge paper positions. And since most of these contracts settle in cash, not physical gold, the actual scarcity of the metal rarely affects short-term prices. This creates a strange dual system. You have physical gold, which is scarce and increasingly being hoarded by central banks. And you have paper gold, which is abundant and used to influence price signals. This creates an illusion of stability, even as the physical supply tightens. The goal isn't just manipulation, it's monetary management. If gold were allowed to skyrocket uncontrollably, it would signal a massive crisis of confidence in our currencies. By moderating its rise, governments extend the life of the current debt-based system. But moderation is not suppression. A controlled ascent is still an ascent. History also shows a fascinating pattern for how nations deal with overwhelming debt. When a country accumulates so much debt it can't possibly repay, it has three choices. Default openly, which is politically disastrous. Inflate the debt away, which is a slow and painful process for its citizens. Or reset the system using gold as the reference point. A gold-based reset doesn't require a government to announce it's bankrupt. Instead, they simply redefine the value of money. Here is how it could work. The government revalues its gold reserves at a much higher official price. This instantly strengthens the national balance sheet without actually having to repay any debt. Public confidence can be restored because gold now appears to back the currency again. And all that existing debt becomes much less of a burden relative to the newly priced gold. No one calls it a default. They call it a revaluation, a polite word for the same thing. This has happened before. In 1934, the US raised the price of gold by nearly 70%, instantly shrinking its debt burden. Many emerging markets have used gold revaluation to stabilize collapsing currencies. A future gold revaluation isn't just speculation. It's a historically proven solution to unsustainable debt as the world slowly edges toward a multi-decade debt reckoning. Gold is no longer just a shiny relic. It's a strategic instrument, a geopolitical asset, and the silent beneficiary of a system that has stretched itself far beyond its limits. The more governments manipulate currencies and markets, the more individuals, institutions, and entire nations will rediscover gold's true role as the ultimate backstop. Not because it's magical or nostalgic, but because gold is the only asset that requires nothing from anyone, not trust, not policy, not politics. Gold does not default. Gold does not lie. It doesn't bail out governments. It simply waits for the moment it is needed again. And that moment is getting closer every day. For decades, the United States maintained its financial dominance using familiar tools, treasuries, the dollar's reserve status, and even managing the price of gold. But as the 21st century unfolded, a new force emerged, one that no government anticipated. But every government quickly learned to exploit cryptocurrency. What started as a niche experiment in digital libertarianism has quietly become something far more significant. It's a tool of macro-monetary strategy, a magnet for global liquidity, a pressure valve for debt markets, and ironically, a testing ground for a future financial system that might not be centered on the US dollar. Crypto didn't become powerful because governments embraced it. It became powerful because governments allowed it to grow just enough to serve their own needs. And now, lurking in the shadows of America's massive $37 trillion debt problem, crypto has become a silent partner in monetary engineering. It's an asset class that lets the government recreate money without printing a single new dollar, attract global capital without issuing new sovereign debt, and experiment with technologies that could shape the entire post-dollar world. Let's explore how this happened. First, let's talk about how crypto lets governments recreate money without printing dollars. Traditional money creation is obvious. We all see it when the Federal Reserve expands its balance sheet, or when Congress runs a multi-trillion-dollar deficit. The result is inflation visible, painful, and undeniable. But crypto creates a kind of shadow liquidity. Every time Bitcoin surges, every time a new stablecoin is minted, or a new crypto derivative is created, it provides something governments desperately need: extra liquidity that doesn't show up on the Fed's official balance sheet. Think about it. Wealth generated from crypto creates new spending power without the government having to issue money. Crypto speculation fuels leverage that mimics traditional credit creation. Stablecoins increase the global circulation of the dollar without the Fed actually printing more dollars. And crypto exchanges create dollar substitutes that behave just like cash reserves. The US government doesn't need to formally increase the money supply. If the market does it for them through these private instruments, crypto becomes a parallel liquidity engine, one that absorbs investor demand, fuels risk-taking, and supports asset prices, all without official intervention. This is the genius of modern monetary strategy. Offload part of the money creation process to the private sector, and then supervise it just enough to make sure it aligns with your national interests. Now, crypto isn't just one thing. It's a whole collection of tools, each with its own monetary implications. Let's look at the three most significant: Bitcoin, stablecoins, and CBDCs. First, Bitcoin. It's often called the new digital gold, but its creation was a godsend not for libertarians, but for governments. It satisfies the public's hunger for an asset that isn't inflationary, while still being transparent, trackable, taxable, and integrated into financial markets. Unlike physical gold, Bitcoin can be unlike offshore banking, Bitcoin flows can be monitored. And unlike cash, Bitcoin holdings can be linked to real identities. It gives people a pressure valve, a place to run when they fear inflation without letting them leave the system entirely. Next up are stablecoins. These have achieved something truly extraordinary. They've expanded the influence of the US dollar across the globe without the Federal Reserve needing to print a single extra dollar. Stablecoins like USDT and USDC circulate in dozens of countries, often seen as a superior alternative to unstable local currencies. In effect, stablecoins increase global dollar demand, amplify the financial benefits that come with being the world's reserve currency, and embed US regulatory power into foreign markets. In an era where America can't afford to raise interest rates forever, stablecoins help tighten global dependence on the dollar without painful monetary tightening. Finally, there are central bank digital currencies, or CBD. While the US hasn't launched its own full-scale CBDC yet, it's watching global experiments very closely. China's digital yuan, Europe's digital euro, Singapore's trials with programmable money. Each of these tests teaches the US one critical thing: a programmable dollar will eventually be needed to maintain financial dominance in the future. And crypto provides the perfect research environment, an open laboratory for the US to analyze how digital assets behave in the real world, without risking the reputation of the Federal Reserve. Now, this is the part that few analysts really understand. Crypto is onto just a speculative playground. It's a massive liquidity vacuum. When foreign investors put their money into US-based crypto ETFs, exchanges, or stablecoins, they are unknowingly pumping capital into US financial institutions. They're increasing the demand for dollar-denominated assets, supporting US liquidity cycles, and even reducing the upward pressure on U.S. Treasury yields. Crypto has become a magnet that pulls global liquidity into channels regulated by the United States. For investors in emerging markets, crypto is often a way out of collapsing local currencies. For wealthy Europeans and Asians, it's a way to diversify away from their domestic systems. For institutions, it's a new frontier for speculation. But all these roads lead to one destination: American financial markets. This is not an accident. It's a structural design. When stablecoin issuers hold reserves, where do they park that money? U.S. Treasury bills. Billions and soon trillions of dollars flow into the safest security on Earth. In other words, foreign crypto users are inadvertently helping to finance U.S. government debt. Crypto began as a rebellion against Wall Street, but now it's being absorbed by the very institutions it sought to overthrow. BlackRock's Bitcoin ETF is the clearest example of this. This shift marks the final phase of institutional capture. First, it means control over price discovery. Once Bitcoin becomes an asset dominated by ETFs, its price is no longer driven by retail users. It's driven by institutional flows, derivative hedging, market-making algorithms, and complex cross-asset strategies. This places Bitcoin under the exact same market architecture that governs stocks, bonds, and commodities. Second, it means integration into the U.S. financial system. With ETFs, Bitcoin is custodied by U.S. regulated entities. Capital flows are tracked, liquidity is centralized, and systemic risk is contained. Bitcoin is no longer an escape from the system. It's becoming an extension of it. Third, this provides huge geopolitical leverage. If the majority of the world's Bitcoin is held through U.S.-based ETFs, the U.S. effectively controls Bitcoin's liquidity, its settlement rails, and access to it for foreign markets. This transforms a supposedly neutral asset into a strategic American asset. And finally, it's a training ground for the digital financial architecture of the future. Bitcoin ETFs normalize things like digital settlement, tokenized reserves, real-time flows, and multi-asset digital portfolios. These are the very tools that will be needed for a future post-dollar system. You see, crypto isn't the end game. It's the test environment. Every major component of the next financial system is being quietly tested in the crypto world right now. Tokenized assets are a preview of future treasury markets. Smart contracts are a test for programmable monetary policy. Decentralized exchanges are a model for global, frictionless clearing. Stablecoins are synthetic reserve assets, and digital identity links are building the anti-money laundering infrastructure of tomorrow. Crypto is a sandbox for the financial order that will eventually replace the current dollar system, especially once the current debt cycle reaches its limit. It's disruptive enough to innovate, but controlled enough not to threaten the government. And the U.S. government, contrary to popular belief, loves nothing more than controlled chaos. It reveals what works, what fails, and what can be co-opted for its own purposes. So, crypto is not a revolution against the state. It is fast becoming the state's most useful innovation. It's a liquidity sponge, a global capital magnet, an experimental monetary lab, a geopolitical instrument, and a parallel balance sheet that doesn't belong to the Fed. In a world where America's debt is unpaid, crypto provides the tools needed to extend the current system just one cycle further, while simultaneously laying the groundwork for the next one. Crypto is not the enemy of the U.S. It's the latest addition to America's monetary arsenal. The old weapon gold anchors confidence. The new weapon crypto absorbs liquidity. Untold, they shaped the silent strategy behind America's debt survival. If you've been following this story, you might have noticed something strange. Gold and crypto, often seen as complete opposites, are starting to move in sync. Gold is the old world anchor, the ultimate measure of monetary truth. Crypto is the new world engine, driving wild monetary experiments. And now, they're converging into a single, powerful system of debt engineering. This system allows the United States to quietly reshape the entire global financial architecture, all without ever announcing a formal reset. This convergence isn't some random market event. It's the final stage of a strategy that's been decades in the making. Think about it. When a country owes more money than it can ever realistically pay back, it has two choices. It can default openly, admitting it can't pay its bills, or it can default silently. The U.S. has absolutely no intention of choosing the first option. So instead, it's building the scaffolding for the second. It's an orderly, sophisticated, global-scale restructuring of its massive debt burden, all done through a controlled revaluation of assets, currencies, and money itself. Welcome to the new era of what we can call debt engineering 2.0. To really get what's happening, you have to accept a simple but uncomfortable truth. The world can't sustain its current valuation structure. Pretty much everything is overpriced. Bonds, stocks, real estate, while the currencies propping them all up are losing value year after year. Historically, when the monetary system got to this breaking point, gold played the role of the ultimate reset button. Gold's price was allowed to rise, which quietly reduced the real value of all that government debt. Today, that mechanism still exists, but it's no longer enough on its own. The financial system is just too big. The debt is too enormous. The leverage is too extreme. Gold alone can't support the weight of the next cycle. This is where crypto comes in. Crypto fills the gaps that gold can't. It offers speed through instant global liquidity. It offers scalability, as the market can grow on demand. It brings synthetic leverage through derivatives, ETFs, and tokenization. And it's programmable, allowing for things like smart contracts and automated liquidity flows. So, gold anchors the reset, and crypto accelerates it. Together, they form a powerful dual-system repricing engine, one that's capable of restructuring global balance sheets without triggering mass panic and chaos. When gold's price is allowed to climb, government debt becomes cheaper in real terms. When crypto expands, global liquidity silently increases. You see the genius of it. Gold devalues the past, and crypto finances the future. Both help America survive the present. So how exactly does the United States benefit from this? Well, the U.S. understands better than any other nation that you don't actually need to solve debt crises. You just need to stretch them out, repackage them, and redistribute them. The convergence of gold and crypto gives America three huge advantages. First, it reduces the real value of its debt without ever having to call it a default. If gold's price rises significantly, whether it's through market forces or just policy tolerance, the purchasing power of the dollar drops relative to real assets. This means the real value of all that outstanding U.S. debt shrinks. Treasury repayments become cheaper in real terms. The U.S. is essentially transferring wealth from its bondholders back to itself. This is the oldest trick in the government survival playbook. But now, with crypto expanding liquidity on the side, the U.S. can let gold climb without destabilizing the whole market. Gold compresses the obligations, and crypto inflates the liquidity. It's the perfect two-engine system for a soft default. Second, it extends the timeline before the system finally breaks. You don't need to fix a broken system if you can just keep it running long enough for the next version to come online and replace it. Crypto's explosive growth, especially through ETFs and institutional adoption, is absorbing a ton of global liquidity. Capital that would otherwise flow into U.S. treasuries, put pressure on interest rates, and accelerate the whole debt spiral. By channeling global capital into crypto markets, the U.S. reduces the immediate stress on its own bond market. In short, crypto buys time. And in a debt crisis, time is the rarest and most valuable currency of all. Third, it shifts risk from the U.S. government to the global market. Every single dollar that flows into a Bitcoin ETF, an Ethereum ETF stablecoin reserves, or tokenized assets is a dollar that could have put pressure on treasury markets. Instead, that dollar becomes part of a system where investors take on the risk. Institutions manage the risk, and the U.S. government indirectly benefits from the foreign investors buying Bitcoin ETFs without even knowing it, relieving pressure on the dollar and funding the liquidity channels that support U.S. markets. In other words, the rest of the world is funding America's transition to the next monetary era without even realizing it. So what does this next version of the global financial system actually look like? It's not going to be some big, sudden Bretton Woods moment. There won't be a conference in New Hampshire where world leaders redefine the global order. It will be a gradual reconfiguration, one that's already happening right now. And it's built on three main pillars. The first pillar is the tokenized U.S. dollar. Let's call it 2 United States dollars. This will be a programmable digital dollar, Probably not a full-blown CBDC at first, but something close enough. It will allow for real-time taxation, targeted stimulus payments, and greater control over capital flight. It improves surveillance and enables instant global settlement. USD 2.0 won't replace physical cash, at least not right away. It will just supplement it. But over time, $2 will become the new infrastructure for international finance. The second pillar is a revalued gold benchmark. Gold will remain the anchor of trust, but not through a formal gold standard. Instead, gold will become the shadow collateral behind all that sovereign debt. Central banks will allow its price to rise in controlled increments, and it will serve as the silent reset mechanism for their debt burdens. This revaluation doesn't need legislative approval. It just needs market tolerance. The third pillar is regulated, institutionalized crypto. Crypto will be fully absorbed into the existing financial structures. We're talking ETFs, custody services, derivatives, regulated stablecoins, and tokenized securities. Crypto becomes the test environment for new monetary tools, the global liquidity absorber, and the alternative asset class that takes pressure off the traditional system. Crypto was never going to overthrow the dollar. It was always going to help rebuild it. Of course, this transformation isn't without its risks. Convergence doesn't mean stability. It just means transformation through tension. And there are four major risks that threaten this transition. The first is a liquidity shock. If crypto crashes violently or gold spikes too fast, liquidity could evaporate. Markets could seize up, treasury yields could soar, and confidence could collapse. A very delicate balance is to be maintained. Second, a crisis of trust in the US dollar. If investors start to believe that USD 2.0 is just a more controlled, more manipulable version of the current system, we could see a massive flight of capital toward real assets. Trust is the only true currency, and once it's gone, it's hard to get back. Third, we could see global currency wars. China, the EU, Russia, and the Gulf states are not just going to sit quietly while the US restructures its debt at their expense. We should expect competing digital currencies, competing commodity-backed systems, and competing crypto frameworks. We'll see new alliances built around stability rather than ideology. The next financial war won't be fought with tanks. It'll be fought with blockchains, interest rates, gold flows, and capital controls. And fourth, there's the risk of a system that becomes too complex to control. By combining tokenized dollars, institutional crypto, reballowed gold, and algorithmic liquidity, the US is creating a system so sophisticated that even the policymakers might not fully understand it. And complexity always breeds fragility. So, to wrap it all up, the future is, I'm going to bring a dramatic announcement like the United States. Hereby, resets all national debt. No, the US will do something far more elegant. It will let gold rise, let crypto expand, tokenize the dollar, financialize everything, shift the risk outward, and quietly dilute its obligations. The debt won't be erased. It will be reinterpreted. The US isn't solving its debt crisis. It's building a new monetary order where the debt no longer matters in the same old way. Gold rewrites the value of past promises. Crypto enables new forms of liquidity, and the United States dollars governs the future of money. This isn't a collapse. It's a redesign. It's a controlled demolition of the old system to make room for a new one. And the world won't even see the reset when it happens, because it will look like progress.